Hi and welcome. Linus here for dollarscaler.com. Today is going to be a great walkthrough of the book A Random Walk Down Wall Street. And this is going to be the key takeaway presentation. Of course, this is Burton Malkiel's classic investment guide. So without further ado, let's jump in. Okay, so the agenda is pretty hefty for this book, and I'm not going to read through it because we're going to see it play out in the coming few minutes. So this is quite an interesting investment guide in the sense that it proposes the effective market hypothesis and its implications for investors. So the efficient market hypothesis proposes that it is impossible to consistently outperform the market through stock picking or market timing, because stock prices already incorporate all known information. So this is the hypothesis, and the implications of it is actually quite interesting. So stick around for that. Investors need to understand that that in an efficient market, all available information is already reflected in the stock prices, making it difficult to achieve above average returns without taking on higher than average risks. Interesting take of it, because the implications, as I said, is pretty profound. This hypothesis has significant implications for investors, highlighting the importance of adapting a long-term, diversified investment approach rather than trying to time the market or pick individual stocks. So I think this is very good for especially new investors to know about and to learn from. But let's deep dive a bit deeper. The question then becomes, is stock picking effective? And the book says that no, stock prices move randomly and unpredictably, supporting the idea that active trading strategies often underperform compared to passive management. In plain English, when you try to pick whatever you fancy, you're usually actually not making better choices than what the market is already providing at large. So it's very hard to beat the market. On number 2 here, random walk theory suggests that historical price movement or pattern cannot reliably be used to predict future prices, making stock picking a challenging strategy. And if you've been doing this for a while, you know this as well. Number 3, investors are encouraged to consider the efficiency and transaction costs of frequent trading. Of course, when you're on a platform that earns its money from you trading, they will design it in such a way that you feel compelled to buy, sell, and maybe that is not the most efficient way to capitalize or get a yield from your capital in the market. The theory then views as a potential diminishing returns game. So then it proposes that index funds, and why? It's a low-cost diversified investing strategy. Burton Malkiel recommends investing in index funds as a cost-effective and efficient way to achieve a well-diversified portfolio that mirrors market returns. Again, trying to play at the game's own rules. So you diversify into index funds that actually basically says, this is how the market is doing and I'm capitalizing on. The book argued that active trading strategies often underperform compared to passive management, supporting the idea that stock prices move randomly and unpredictably in line with the random walk theory. It's very hard to outperform the market. Efficiency, low cost, and long-term performance of index funds are highlighted, making a compelling case for their use in investment portfolios. Should you stick to only this? No. As you know, if you've been around the dollar scale for a while, there's hundreds of ways for you to, from saving more money every month to investing your money in different aspects of your life. You shouldn't put all eggs in one basket, and I think that is particularly true moving forward into the future. But in this book, he makes a very good case for the long-term performance of index funds, and it's very hard to beat. Diversification strategies then. How to balance your investment portfolio. Malkiel emphasizes the importance of diversification across different asset classes, such as stocks, bonds, and real estate, to reduce risk and optimize returns. And of course, some of you will say, and the cryptocurrency, and some could say in minerals and in precious metals. There's a lot of different things you can invest in. But in this case, this is what they focus on: stocks, bonds, and real estate. The book recommends global diversification to spread investment risks across different countries and regions, taking advantage of growth opportunities in international markets. Basically, if you're based in the States, do not just buy index funds that care about the States. Be in India, be in Africa, be in Europe, be all over the place. Diversifying across different industries and sectors is also highlighted as a strategy to minimize the impact of economic fluctuations on investment returns. So basically, be a global trader, be everywhere, and enjoy the ride. And then he dives into the basics of bond investing, what you need to know. Malkiel explains the different types of bonds, including government, corporate, and municipal bonds, and their role in an investment portfolio. He highlights the risks and rewards associated with bond investing, emphasizing the importance of understanding interest rates and credit risks. He highlights the risks and rewards associated with bond investing, emphasizing the importance of understanding interest rates and credit risks. He also discusses the concept of bond duration and its impact on investment performance, providing a comprehensive overview of bond investing essentials. So if you're interested in that, absolutely buy this book. Something that is much more dear to my heart is the behavioral finance. Behavioral psychology at large is something I find very fascinating, coming from an experienced design background. Understanding how psychology affects investing, and I think this is good for you as an individual, looking at how do I see it from your own perspective. Investors' overconfidence leads to higher trading frequency and lower returns. So you think you're good at something, you buy, you sell, you buy, you sell, but if you would just have left stuff alone, you might have actually gained more, especially when you consider the cost of buying and selling. Then we have a favorite, the FOMO, fear of missing out, often influences investors to make irrational decisions based on market trends and hype. And we see this all over all the time. So it doesn't matter if it's in a crypto craze or if it's in AI craze, whatever it is, we see people flocking to what they think is going to be lucrative in the near-term future. Of course, that might be a very good strategy or at least a tactic. Then it's about being first, right? Loss aversion causes investors to feel the pain of losses more than the pleasure of gains, leading to a conservative risk choices. So bring this with you when you invest and try to see your behaviors before you act on them. Let's keep on digging for the gold nuggets. Fundamental analysis investing. Does it still matter? Burton also acknowledged the limits of fundamental analysis in beating the market, but also highlights its role in understanding the financial health and potential of companies. The efficient market hypothesis suggests that stock prices already incorporate all the known information, making it difficult for fundamental analysis to consistently, and this is a keyword, consistently identify undervalued stocks. High impact information right there. While it may be challenging to outperform the market using fundamental analysis, it doesn't negate the importance of understanding the fundamentals of a company for informed investment or investing decisions. You should just make sure that you make a sound investment in a financially sound organization or corporation. So, mastering portfolio rebalancing, timing and techniques for investors. Understand the importance of portfolio rebalancing in maintaining a desired asset allocation and managing risk. Don't keep everything in the same place forever. Have a cadence where you go back and see, have I gained the return? Is the market cooling down? Where are we on the innovation cycle? So on and so forth. Make sure to rebalance your portfolio in a timely manner. Explore different techniques for portfolio rebalancing, including calendar-based and threshold-based approaches. So I made 10% out of this investment. Was that the goal? Then should I diversify? Should I reallocate the funds? How should I manage this? Having a clear plan of what you do at what threshold or at what event in time. So have an idea of how you should be rebalancing your portfolio, and you'll be better than most. Consider most amateurs, that is. Consider the timing of rebalancing in relation to market condition and your investment goals. So if you know why you're investing, what time horizon you have, then you can be kind of sound in your arguments to yourself. It's your money. Make sure to be as sound as you can while investing. So, the risks of speculative investments, what every investor should know. I think this is very important. Let's take this one. Burton cautions against the volatility and uncertainty of speculative investments like penny stocks. That is when you buy stocks that cost less than $1, and you buy many, and you hope for some reason that they're going to go up. So this is where a technical analysis could, of course, benefit you. You could buy this because you know that this steel mill, they're actually expanding, or they found a way, they found an ore, or whatever it is that you know is going to affect the stock price. Sure, you can invest in penny stocks. Just because it's a penny stock doesn't mean that it's useless. Yes, be very cautious. Don't buy it because it's a low price. Highlights the danger of market bubbles and the potential for catastrophic losses in speculative investment scenarios. So as soon as something has a hype bubble, like the internet in the early 2000s, it also emphasizes the importance of conducting thorough research and understanding the risks before engaging in speculative investment. So yes, yet again, be sound. Google whatever you're going into and see what is the downfalls, what is the potential upticks and the potential downfalls. Make sure you don't just emotionally run into something because of FOMO. Tax-efficient investing, strategies to keep more of your returns. Utilize tax-advantaged investment accounts like 401ks and IRAs to reduce taxable income and grow investment tax-free. Consider long-term capital gains by holding investment for more than a year to benefit from lower tax rates on investment returns. This is relevant to certain markets or regions. Choose tax-efficient funds and investment strategies that minimize annual taxes, such as index funds with low portfolio turnover. So these are some of the strategies, key takeaways from the book. And that is a summary and key takeaways. I hope you enjoyed it. I hope you gleaned some insight from it. If you want more of this, you can find a lot of articles that we write. And this is part of an article series that we made about this book because it's a very valuable book, we think. You can find that and much more over at dollarscaler.com. I hope you found it interesting and that you gleaned some new knowledge, because we think that financial freedom is just one insight away. And till next time, this is Linus signing out.